Yo, what's up, everybody? Matthew Decker here, Leveraged Wealth. Taking a quick walk in the middle of the day. It's Inauguration Day. Joe Biden's currently giving a speech, and I'm out here on a walk. But it being Inauguration Day, it got me thinking. I was looking a couple days ago, building a presentation for a group of local businesses here, and they wanted me to talk about just kind of the State of the Union from a revenue tax standpoint, spending, all of that. And that's a presentation that I've given at a bunch of local colleges here in the Atlanta area. And so I thought I'd just share some of that with you guys. It's pretty interesting stuff, really. So sitting here right now, there's a really big concerning line item that our country has that nobody really talks about. And it's called unfunded liabilities. So what the heck is an unfunded liability? Well, an unfunded liability is, to make it simple, something that our government has promised to pay in the future, but we're not currently paying on now. And so these would be things like future Social Security payments, future Medicare payments, things like that. Those are two of the biggest line items in future unfunded liabilities, interest on our debt, future unfunded liabilities. All those fall into that category. And what's really concerning about our future unfunded liabilities is right now, future unfunded liabilities are north of $150 trillion. $150 trillion. So we could essentially, that's a huge number. I don't have to tell you that. We could essentially cut our spending in half, the amount of money that we spend, our government, each year. We could cut our spending in half. We could cut it in half again. We could then save, on top of cutting our spending in half twice, we could then save half of our tax revenue every single year, and it would take us more than 50 years to pay off our future unfunded liabilities, and that's cutting our spending in half twice and saving half of our tax revenue every single year. It's a crazy number, right? Crazy number. So why am I talking about this today? Well, I'm talking about it today because it's Inauguration Day, and there's absolutely no indication that either party, whether you voted for Joe Biden or whether you voted for Trump, doesn't really matter. There's zero indication that either party has any interest in getting our spending under control. And that tells me one thing for sure, and that is that at some point, the rooster is going to come home to roost, and we're going to have to increase our taxes drastically. It's the only way that we can get our spending under control. The only way, increasing taxes drastically. And that leads me to something that we talk about all the time. Two things, really. Number one, thoughtful Roth conversions. It's one of our main pillars of our planning. People should be doing Roth conversions. Now, there's a right and a wrong way to do it, but having your money protected from taxes forever, both the principal and the growth, is a beautiful thing. And so we love Roth conversions for that reason. And the second thing is looking at life insurance as an alternative asset class, specifically for those that make too much money to either contribute towards a Roth IRA or, are looking for something that's maybe diversified away from the market. And what's interesting about life insurance in particular, Roths hardly ever come under scrutiny, but life insurance comes under scrutiny all the time. I get questions literally every week in my email or on YouTube. People even call in and ask, what happens when the government decides to take away tax benefits for life insurance? I literally get that question every week. And what's interesting is January 1st of this year, we actually put in place an additional piece of legislation that cements the tax benefits of life insurance. In fact, it made it even better. The way that life insurance works is back in the 80s, there were 3 pieces of legislation that was written called TAMRA, TEFRA, DEFRA. Prior to those 3 pieces of legislation, there were no guidelines on life insurance, specifically what life insurance is and what life insurance is not. And so you had people, wealthy people, putting in millions of dollars into life insurance without actually buying much death benefit. So you might put $1 million into a life insurance policy for the tax benefits, but your death benefit might only be, $500,000. Well, if you're paying $1 million premium for a $500,000 policy, that's not a life insurance policy as we know it today. And so the IRS came out and they nixed that as a tax strategy. And instead they came up with 3 pieces of legislation, TAMRA, TEFRA, DEFRA, that essentially cemented what life insurance was and what life insurance was not. And it said, hey, you can absolutely get all these tax benefits associated with life insurance, but there's a certain way that you have to do it. You have to buy a certain amount of insurance relative to the premium that you're paying. That's what those 3 pieces of legislation essentially did. Boiling it down for YouTube. But that's basically what it did. Well, this year, what they actually did is they passed a piece of legislation that said, we're going to essentially cut the requirements in terms of the amount of insurance that you have to buy relative to the premium that you're paying. They cut that in half. And so now life insurance is actually less expensive, and yet all of the tax benefits exist. Meaning, assuming you play by the rules that our legislation has basically put into place, that the legislature has put into place, assuming you play by the rules, money goes in, it grows tax-free, it comes out tax-free. If you withdraw at a basis or if you take policy loans, those are tax-free. And what they essentially did is they made policies now cheaper than they were previously. So with $150 trillion of future unfunded liabilities that our nation has virtually no shot of paying off without significantly increasing our taxes that we pay every single year. David Walker, former Comptroller General of the United States under Bush and Clinton, he actually was an advocate. This is probably going back 7-8 years now. He was an advocate of doubling tax rates. Those are his words. He said we're going to have to double tax rates in order to essentially overcome our ever-mounting debt. And I think that was back in 2012 when he went on a national speaking tour to talk about that, somewhere 2011, 2012. So those are his words, those aren't mine. And he would know, former Comptroller General, the main accountant for the United States of America. And our spending has only increased and accelerated since then, over the last 8 to 10 years. And so now might be the absolute best time to start protecting your assets from the inevitable rise in tax rates. And in my opinion, the 2 best ways to do that, Roth conversions and cash value life insurance. So if this is something that you're interested in, something that you want to explore, reach out to us. You can send us an email at info@leveragedwm.com, or you can just go to our website, or you can click on the link in the description of this video, and it'll take you to a little page where you can reach out to us and let us know how you think we can help. Either way though, happy Inauguration Day. Whether you voted for Biden or whether you voted for Trump or whether you voted third party, hope that we all realize that we're all Americans and that everybody here, no matter who you voted for, wants the best for their family and wants the best for this country. And until next time, stay classy.